the Edge demo and discussion for September 14th. I'm Tim Quast. Good to see you guys. I always look forward to this. John, I hope you didn't mind, John Cook, that I took your name in vain in the market desk note this morning. We found that stuff to be pretty interesting that you shared with me, and I thought it was worth sharing with others. I have these conversations. What we're talking about, by the way, if you don't get the market desk notes, so John sent me this exchange on Twitter where one of the Citigroup analysts, so research analysts, we call that colloquially sell side analyst, went on a rant about how stocks just don't behave the way they should. I'm oversimplifying, but Brian Wilson, who spends a lot of time with our public company customers, this is a core concern of theirs. That report results. I had a conversation today with a public company who said, we had good results out August 30th, matched our guidance, and the stock went down 8%. And why did that happen? And I could tell them, looking at the data, why that happened, but it's a source of great frustration. And of course, for traders, the same thing is true. You look at a stock that you think should perform well. Maybe you're looking at technical signals and you think those look pretty good, or you look at their fundamental performance, how the business is performing, and you say, well, that's a superior business, growing faster, better margins, better position competitively, and it doesn't do what you expect. So that's why Market Structure Edge exists, by the way. So I know a bunch of you veterans, you all know this, but look, it's permeating the markets. When you have a sell-side analyst whose job it is to differentiate companies with better fundamentals, and that guy is saying the problem is market structure has changed permanently, then it's leaking into the corners of Wall Street. Okay, so Brian and I are actually going to tag team this so that you get more value. I mean, Brian will say something useful. So I'm going to take the first part, and he's going to cover things next. But I'm going to talk about two things: getting stopped out. I've come back to this theme because I experiment, and then I share it with you because I'm not the expert trader that probably a lot of you are. I'm a market structure expert. I will readily say that we know a great deal. I know a great deal about the mechanics of the market, the rules. I read rule filings. I like to read those things and figure out what are they trying to do. I read regulation, national market system, stuff like that. That stuff, I've been doing it for close to 20 years. So I know the mechanics and what the exchanges are trying to do, what the high frequency traders are trying to do. I understand that stuff fully. But I learn things every week about what does and does not work using market structure data, and you may do the same thing. So I want to talk about that, and then I mentioned it I think 3 times in market desk notes this week about what do you do in this environment. So we will talk about that. And for those of you who are new and you're tuning in, and you're saying, well, I want to know how to use the platform. We will always try to hit on a few concepts about how to use the platform, and it takes time. It does. I wish I could tell you that in 4 weeks you'll have it all figured out and everything will work perfectly. It would be unrealistic, but you can learn what works and what doesn't, how to protect yourself from risk, and how to produce consistent returns. And there are times when it's going to be very difficult. So the very basics here are, if you're new, is this is not going to look like probably any other trading decision support platform that you've seen. We are heavily focused on 2 things: demand and supply. So if we're looking at low volatility, it's got very consistent demand. I don't know, hey, Brian, I'll let you let somebody in if there's a person knocking at the door there. And then supply is short volume. Demand's an algorithm. The market is algorithmic, so we use algorithms too. We want to meter buying and selling by investors and traders. We do that by consuming data from a variety of data providers, including the exchanges. We look at how orders are handled. How they comport with the rules tells us a lot about them, and whether the buying is outpacing selling and vice versa. Algorithms are designed to deceive. They're designed to make buying look like selling and vice versa. Over 95% of all orders are canceled. So they put in massive amounts of orders and cancel most of them. And in that cloud of smoke, there's stuff occurring. Well, that's the stuff we measure to try to figure out, well, which way are things going? It's the hardest thing to know. How should you position yourself to take advantage of what is occurring in the market? And everybody's trying to deceive you. It's one of the great problems in the market, what's called adverse selection, meaning you go to buy something, and then after you buy it, then the price changes in a way that is adverse to what you paid or received. It happens all the time. And it's a product of different purposes and time horizons. But if you're looking at this platform for the first time, there are some very simple things to know. You can look up sort of the 30-day view of supply and demand very easily for any stock, or find what portfolios that stock is in. I've got Colgate Palmolive up here because I'm going to use that as an example. And that's very easy to do. We create these two portfolios here for you because there are really two things to trade. You could call it value and growth if you wanted to. I think those would be deceptive terms for us because we're not talking about whether things are trading at a discount to fair value, however you define that, cash flows, comparables, sum of the parts, and growth. Things that have accelerating financial returns. That's not how we're looking at it. We're looking at accelerating demand and insufficient supply, or low volatility, things that have very steady behavior. They're going to be core planks in index funds because they don't have much volatility. And when things are volatile, when the market is volatile, money tends to shift to those things. So it's not perfect, doesn't work every time. And we'll look at these and say, well, if there are 30 in here, it's a big momentum market. We had close to that many in just the latter part of May. And that was a great time. You could produce 20, 30, 40% holding on to some of these tens with falling supply during that period of time. Right now, there are two, and they're both down today. It's not a momentum market, despite that you say, well, Tim, the Dow's up 300 points. What do you mean it's not a momentum market? Bear with me, I'll explain that. And when there are 25 or something like that in the low volatility portfolio, clearly that's where the money is going. It's not either at the moment very effectively to me. But those are important, simple things to know about the platform. I trade out of these. I don't go root around. I'm just going to use those. And if there's nothing in it, then I might be shorting the market or sitting in cash. I'm in cash, but I may well short the market before the close today, and hopefully before the last half hour. Really, because last half hour, right ahead of index rebalances tomorrow, everybody will jam into the market there. And so I'd like to be just ahead of that if possible. And I don't know what's going to happen. No one's got a crystal ball. But if you're looking at what's occurring right now, this is what's happening. So demand is falling and supply is very high. Now, it'll be interesting to see what happens in the data tomorrow. Did people cover shorts today or not? Brian's probably going to talk about this, and I don't want to steal his thunder, but I look at this as index arbitrage. So index, AM-dated index options expired today. Massive baskets of those are used by index funds and exchange-traded funds to true up their tracking. Well, a bunch of quant, even trend-following firms could do this, but particularly quant traders could go around and buy baskets of those in the hopes of driving up the value of the underlying assets and the options that trade on them that expire tomorrow, the monthlies. Because if you could get that to happen, you could maybe sell the option to somebody today or exercise it and dump stuff tomorrow, and the market could give back all that of its gains today and more. I'm not saying that's going to happen. I can't predict what's going to occur. But as I said in the note today, don't expect the market during options expirations to behave the way that you think. And here you have this sudden update. That is the explanation. It's not, it's not wholesale inflation data and everybody shrugged off the increase and they're looking for a soft land. That's not it. That would be rational. The market doesn't have the capacity to make a rational decision in a day. There isn't enough liquidity. So this is the thing that's occurring. Again, I don't know what's going to happen, but this is how to think about what to do. And if you're reacting to a day, you're reacting and gambling. It is not a trend. It is not a pattern. It won't tell you what's coming. That's much more important to me than what happens on a given day. Now, to getting stopped out, my other quick thing to talk about. So I bought, here, it's a great example, and it's happened to me a number of times here in September. I mean, I had a great August. August was, I was taking great care to buy things down at least half, if not more, of intraday volatility, which really shrinks the choices, so that I could take those very short-term gains. So then in September, I have tested, well, what if I just take the midpoint? You can use a midpoint algorithm. I've used Interactive Brokers. They offer a variety of trading tools like that. You could use that. And I've set shallow stops, and it's been a mistake. So it happened to me in CL here. I look at the supply-demand equation. I say, this is pretty good. Why would I buy it? Very steady demand, plunging supply. It's changing now. This is high frequency traders covering that, and so that should give me a lift at least on a day or two here, right? So the trouble is, so I buy it, I buy it just basically right at the market, and I set my stop down about 75 basis points, and I got stopped out yesterday because it went right through that. And look, I have a reasonable chance to produce a 1% return in a couple of 3 days. That's kind of my aim in a stock like this. And so if you look at what happened, could I have made a return? Well, yeah. I mean, I could have gotten that return, but my stop was too shallow. It's a risk that you have to take. The average volatility in the S&P 500 is 2%. What that means is a stock is likely to move 2% intraday on average. Doesn't happen all the time, but it's a pretty good read. And it's a consequence of the prevailing behavior in the market, which is passive investment. Folks tracking a benchmark like an index fund, like an S&P 500 fund. And if there is more than a 2% variance versus that benchmark, the mutual funds and exchange traded funds, it affects their ability to sell those funds. Distributors won't sell things that are varying more than 2% from the benchmark because it's not a reliable return. The SEC frowns on that. They'll look at your prospectus and say, well, you claim to track this, but your performance isn't, and you get dinged. Well, nobody wants that. So they want things that will hew closely to the benchmark. That money isn't looking for outperformance. Okay, so that's what I'm after here. I want half that performance, basically. I'm expecting to be able to capture it. It's a reliable way to produce returns. The trouble is I may have to take more risk. If I'm going to take a midpoint price, maybe my stop has to be down 1.5% instead of half that, 75 basis points. Well, I don't want to lose 1.5%. But I don't want to get stopped out either. If you get stopped out repeatedly, that starts to add up. I lost about 2% doing that, and I shouldn't have. So I'll always share with you what I'm doing, and so I've learned a lesson from that, and it's something I will do differently. Comments, thoughts, observations. I know some of you may have experienced it too. So Barry, Dan, John, Tim, I don't know if you guys have comments. Feel free to weigh in.
Myself, because of the data, I've just been sitting on the sidelines. I've not been doing a whole lot.
Yep.
I've been sitting on my hands waiting for an opportunity. Figure, okay, we come into expiration, we see how we do, and it gives me a much better edge as we go into next week.
I think that that's very good advice. You can't get back what you lose, and there are clearly times when it's better to just sit out, and the data show it over and over and over. For the you long-time users know I've talked about this a lot, that we have found statistically, whenever that green part of the graph is above the red line, statistically over the next few days or weeks, the market always declines. It is never not, may not be very much. So then if you're not comfortable with the volatility, the best thing to do is sit out. Because if you don't lose money and everybody else does, and you come back in when it recovers, you're way ahead. So that's the good Barry Norton advice. I think it's a good idea. Any other thoughts, comments?
Tim, why do you think or go ahead,
sorry. I'm sorry.
Go ahead. Go ahead.
I'm the same way. I look for something that just jumps out of the screen. So the only thing I traded in the past couple of days is PBF Energy. That had an incredible chart, but that was it. Yep. Nothing else looked anything like it.
I traded that too, and I lifted my stop well over my entry point, but I got stopped out of that too. I should have made more, but I was happy that I made money on it. But exactly, that was a good trade. Yeah, John.
Yeah, do you think you're so you think you're modeling the volatility wrong, right? Like, are you, if it's telling you it's going to move 4% a day and you're buying it down 3%, but you're placing a stop, at 1%, like the likelihood of getting stopped out to me is within the distribution of what you expect to happen. So is there, do you think there's a better way to model like the stops for volatility, things like that? Like, have you looked at any of that data?
We have looked at volatility data for a very long time. Literally, we have looked at that data for 15 years and watched it get worse. I mean, it's really incredible how much worse that volatility is now than what it used to be. Pre-Reg MS, it's more than 4 times higher than what it was before regulation national market system, and it's deteriorated in the last few years. I don't, is there a better way? I'm always open to suggestions. You've come up with some really interesting ways to look at the data, John. And we use the Cook model to look at the sectors, to look at the distribution of up, down, topped, bottomed. I think that's pretty useful. As I said, we'll put that on the platform at some point. I don't think it's superior to broad sentiment, but it is really informative. I do think it's good data. And the same would apply to volatility. If you guys come up with something that you see, let me know, and we'll run it through the models, because we do a lot of data modeling and see. Right now, I think the point is, and I think it's kind of reflected in those comments from the guy at Citi, volatility is just present, and it creates more downside risk, and maybe one has to have a slightly higher risk tolerance. Maybe really you have to have a 2%. If the whole market is 2% volatile, do you have to have 2% downside protection? And maybe don't do long trades that count on remaining in the trade when supply and demand are working against you. I can't come to a better conclusion than that. All right, that's all. Brian, I'm going to turn it over to you, and then we can do more Q&A. So let me stop sharing, and I'll hand it off to you.
All right. Couple things to walk through. I was going to start with my portfolio itself. There's a reason to my madness here. I have a number of experimental portfolios, but what I want to show you here coming into expirations is just note how often passive investment is coming up here in terms of leadership. So passive, passive, passive. We make our way down the list. You'll continue to see passive investment leadership, as we make our way down this list, one after another. If it's not passive investment, it's fast trading, high frequency traders, day traders. But you get the idea. As we go down this list, you can see passive investment time after time after time. And we'll get down here to the bottom, and we end with utilities with passive investment leadership. Now, why are passive investors moving in the market in this capacity? Part of it is where we're at right now from a calendar perspective. For those that are new to Edge, or if you have forgotten where this resource is located, just go to marketstructureedge.com, go to resources, and then the expirations calendar. And what will pop up is the calendar for this year. Number of items on there. The key is down here at the bottom for different items. What you really want to pay attention to is expirations, though. It's going to be the third Friday. You can see here in September. So third Friday is tomorrow. Expirations started today. Expirations concludes tomorrow. This one also has that green circle on it. If you go down to the bottom here, you can see that's S&P quarterly rebalances. So we're at I call them inflection points. We're at an inflection point in the market coming into expirations, as you could see with my dashboard. Passive investment leadership. Now, why would that be the key? Why would that be happening here during expirations? We see it happening all the time. Part of the reason for that is index funds and ETFs. They have, in essence, extended the reach of the stock market. As you know, there's only a finite number of public companies in the equity universe, and some of these are going to be dollar stocks, but there's somewhere around 3,700 companies right now. Well, if you have a proliferation of ETFs coming to market seemingly every day, tracking different items, logic would tell you that those ETFs cannot go out in the marketplace and literally buy the amount of shares that they need for their ETFs. It's just not possible. So ETFs are basically derivatives instruments. So you get ETFs that are derived from equity products. They're extending the reach of the stock market, and they will, of course, have equity positions, but they're also going to be truing up those positions with derivatives instruments, whether that be something like futures. And you'll also have ETF market makers, if they know directionally, and they get a good idea of this pre-open, what's out there in the marketplace. If they know directionally what's going to happen in the market, they'll position themselves accordingly. Just think about call contracts, put contracts. So that being said, once again, with the leadership we're seeing right now across the market from a passive investment perspective, that doesn't surprise me that we're seeing that type of leadership, but it also begs the question for me, and I could be wrong about this, if passive money is leading going into expirations, what are they going to do afterwards? Will they exhibit the same type of leadership? Now, maybe they will. I don't think they will. Like I said, I could be wrong. Part of my rationale for that is here in green, market structure sentiment. Think about demand in the marketplace. It's starting to slip during expirations, and short volumes are high. If you back up this look just a little bit, take that on a 6-month look, take a look at short volumes. So we are way out above our skis right now, way out in front of our skis. You would have to go back to March to see short volumes that are at about these levels. Now, that being said, we could come into next week, shorts could get covered, and the market could certainly recover. I am putting on a short today. I put on half of my short position before the call. I'm planning on putting on another half afterwards. I could be totally wrong about this. If so, it's similar to Tim. I'll admit my mistakes, and I'll make sure I don't lose too much money on the trade. But I would say right now my odds are in favor. Short volumes are high. Passive investors have been exhibiting a huge amount of leadership going into expirations. To me, they probably won't exhibit that same type of leadership coming out the other side. And by the way, liquidity in the market right now, the last 5 days for the S&P 500, down to 95 shares at a clip. So when we think about the need for passive money to use derivatives products, that's part of it. Can you imagine them going out in the marketplace, 95 shares at a clip, trying to pick up positions? It's just not possible. So that's part of the reason that you'll see passive leadership during key market periods like this, especially during expirations. So that was one point, just talking about the calendar and passive investment leadership. The other one is a very simple point, but it has to do with just a reminder. And for those that are new to the product, once again, Market Structure Edge, go to resources and how to use Edge. And even if you're not new to the product, but just need a refresher, Tim has done an incredible job. Series of 12 different videos. They're short. Most of them are, there's a 1 minute video. Here's a 2 minute video. We go through some of the key things that you'll want to take into account. What is broad market sentiment? What does it tell us? What's the context of the market? We're talking about that right now with the calendar. What is divergence? Why is that important? How do you actually use the Edge dashboard? What are some of the basics for finding stocks? So 12 different videos here, all very helpful. Tim did a very good job with those. And with that, that was my 2 points, Tim, that I wanted to cover. So I will stop sharing.
Yeah, unfortunately, I have a face for radio. That's the only the downside to those videos. And it wasn't just me. We had it. We put our heads together to do those. So the one comment that I would make in context of Brian's observations is you might think, well, those index funds and exchange traded funds can't own derivatives. Well, they can. Any 40 Act. So the Investment Company Act of 1940 defines, so what called open-end 40 Act funds. That's what those are. Both index funds and exchange traded funds, even though ETFs are not fiduciary assets. Most people don't know that. I can explain it. So the 40 Act funds have to be 90% invested. That's the legal requirement. That means 10% can be used for something else. Could be cash, could be derivatives, could be all kinds of things. And you can read through any prospectus and you will find it. You have to read into the middle of the prospectus or read a statement of additional information. There are multiple things that all 40 Act funds have to file: annual report, semi-annual report, prospectus, and statement of additional information. And yes, we read those. We've read hundreds of them and then gone and discussed them with the big complexes like BlackRock. And we've asked a bunch of questions about this stuff. Well, they absolutely can. So that happens. And they actually have longer to true up their overall holdings to whatever measure they're tracking than what are called 13Fs. So a 13F comes from the section 13F of the Securities Act, and it's a report on institutional positions, stock positions, 45 days after the end of the is that right? 45 days after the end of the quarter. So those just came out August 15th from the June 30 quarter. Well, and index funds actually have up to 70 days after the end of the quarter to square their positions, by which point, who cares? And it's completely changed. So it's just important to know that, no, we're not making this stuff up. We don't make assumptions about these things. We do our homework to make sure that we're presenting the facts and understanding what's actually occurring. So questions, comments. We didn't give you a lot of material for asking questions, I realize, and we could come back to what to do in this environment if you would like. Please, Dan, yeah, fire away.
Okay, I had a couple of things related to your portfolio that you talked about last week.
Okay.
You had an exclusion criteria.
Yes.
How often did you check the portfolio and do a replacement if something hit your exclusion criteria?
Let's see. Do I have those? I think those are up on my other machine. So what we did was say, replace. So we had a 20 stock portfolio. So we said replace no more than 2 at a time. So we didn't have this massive turnover. And if we couldn't find criteria, make sure that we leave at least 5. Those were our exclusion criteria. And I'd have to go down through it to see how that played out. But the nice thing is the app tracks all of that and says, well, here's what came up to sell, and here are the things that match the criteria to add. And I could go through each day to check to see what the turnover is. And I haven't checked that. By the way, let me show you something.
So implicitly, you're saying you check every day.
And absolutely check every day. Yeah. So, and if we could get this math to work, this number 4 portfolio over here, by the way, is the stuff currently in that test portfolio that says this is the low volatility portfolio that produced reasonable returns over the last couple of months. Not as good as momentum, but it did produce returns. And so I'm tracking this so that if it works, we'll put it on the platform. So you can say, well, just allocate your resources equally, and now you have a longer term portfolio that you're just going to hold unless and until it tells you to change. And if we check it every day and EFX is gone, then you sell EFX today and something else is in its place, then you buy that. And I mean, I'm not going to put it out there if we haven't fully vetted it to the degree that I'm comfortable that it is way better than a coin flip, right? We've got to have a serious statistical advantage before we'll do that. But we're working on it. We're working on that sort of thing so that you have sort of 3 options for you. It's the short-term trading. That's what I'm doing. It's much like big exposure to the S&P 500, more like John Cook is doing. And then could we do portfolios where it's sort of in between those things? When supply and demand tells us to be out, we should be out too. You might as well sit in cash and earn 4.5% if there's a high probability the market's going to go down 5% or whatever, right?
Yeah, I'm looking at an approach where maybe you check once a week and cut down the trading. I have a suggestion with that.
Okay.
To get a really unbiased test, then you should start it real time going forward and see how it works.
It's always the rub is that past performance is no guarantee of future outcomes, right? So I like that. It's true. I think you're right. We should.
Final question.
Yes.
I had raised this a couple of times about looking at correlations.
Yes.
By stock.
Yes.
Have you thought about that? Is that something you might look into?
To come up with a score, right?
Yeah.
We certainly have. It's on the docket. It's pretty time intensive and it takes a fair amount of development. So we'll do it. I'm very careful about the rate at which we invest in programming, because it'll eat you alive. As I've said before, I've run, software businesses for better than 20 years, and those are the things you have to really carefully watch. But yes, I think it's a good idea. I think you're right. It's not equal, right? That's your point, that the supply-demand divergence is not equal. And certainly our variance soars in stocks under $10. And I noticed in the NASDAQ's model, when they were developing that AI run, what they call mellow, midpoint extended life order, that they use stocks with prices less than $50. Because once you get, you're trading a stock like Google, there's a lot more variance in the outcomes because of the price, even though it's a huge company, right? There's a lot of liquidity. That's a better way to put it. But it's a good idea, Dan. I think it merits research.
Tim, one item that I forgot to mention is Tim is usually very, very busy in terms of his overall schedule. But if I can help you guys, I'm always available via email. Also, Henry Howard. So his email is hh@marketstructureedge.com, and mine is bw@marketstructureedge.com. So especially for some of the new users, if you have questions of, what is sentiment, what is short volume, whatever you might have, please feel free to, send us an email.
Yeah, I'm TQ at marketstructureedge.com. And it might take me a couple 3 days, but I will respond to every email at some point. Okay. Well, it was fairly quiet. I think we killed all the Q&A today. So thank you, Dan, for picking up the baton. Good enough for today. It should be interesting. Next week will be clear. We'll be past VIX expirations, and we'll see whether this cycle turns. I don't know what's going to happen. It's going to be interesting, and we'll have a chat about it next week, next Thursday, whatever day that is. I can't remember. Is that the 21st? I think it's the 21st. Might be the first day of fall, actually. All right, you guys. Thank you very much. Good to see you. Have a good weekend.